Okay, 'tis the season, the holidays are here, and people are gathering around the table. And you know what I get a lot of around this time of year? I get a lot of questions, especially about our Denver, Colorado housing market. You know, as more and more media headlines suggest gloom and doom for the housing market and our economy as a whole, there's a lot of speculation about what is happening right now, as real estate tends to be top of the mind for a lot of people this season. You know, and while I can't fully forecast the future, I can at least show you this month's market update report and talk a little bit about what you might be able to expect moving forward into 2023. You know, one of the most important things to note is that this is a dynamic and shifting market, and it's changing quickly. Yes, homes are staying on the market longer, and we're not seeing that large increase in new listings. Part of that, of course, is due to the fact that it's the time of the year, the holidays are here. People are pulling back because of the holidays. And that seems to be reflective of a much more normal market than what we've been seeing in the last few years. But we're still in a seller's market. Why? Because prices are driven by supply and demand, and we still have a low supply of homes on the market. In fact, this month's report is still holding it to 9 weeks, which was the same as last month. And remember, we would need 5 to 7 months supply of homes available for sale for us to be considered a normal or balanced market. And for the cynics who are calling for a housing crisis or a crash, this quote from Redfin sums it up best. For those bearish folks eagerly awaiting the home price crash, you'll have to keep waiting. As much as demand is pulling back, supply is as well. And that's reducing downward pressure on prices in the short run. Here's what I've noticed. Baby boomers are really looking to age in place, a lot of times because they love their homes, they love their neighborhoods, and they may already be close to the grandkids. So they may have no desire to really move. They're looking to modify their homes. So that might be some of the homes that aren't going to go on the market, leaving us less inventory for that millennial family or that first-time home buyer. And then there's that portion of the population that refinanced their homes when we had those wonderful rates of 2 and 3%. So there may not be much motivation for them to move into a 6 or 7% interest rate with a new purchase. And then there's the sheer lack of availability of homes that we would label, say, first-time homebuyer homes or right-sizing homes because they're smaller and cheaper. They're just not being built by the builders because of the increased cost to build. And when they do come on the market, you have to compete with the right-sizing baby boomer, the investor, and of course, the first-time homebuyer. So all this doesn't mean that you shouldn't buy or you shouldn't sell, but it's just keeping pressure on house prices, because it's affecting our inventory of homes for sale. Now, as we review the latest numbers, you have to remember that we're comparing year over year. However, I believe that that doesn't give you the real picture, because we have to agree from about April of 2020 to about April of 2022, that was 2 years of hair on fire selling real estate in a crazy market, and most likely a market we're not likely to see again anytime soon. So today, let's take a look at some of our figures, and we'll look year over year, but then we'll also compare them back to 2018-2019, that pre-COVID time frame. In the most recent SMEDRA data, that's the South Metro Denver Realtor Association report, we saw that new listings or properties available for sale was down 28.7% from last year. But this number was only down 26.8% when compared to the average of 2018 and 2019 market. Homes under contract or pending was down 36.4% from last year at this time. However, again, this number was only down 26.6% when compared to the averages from 2018 and 2019. Closed or sold homes was also down 42.9% from last year at this time for both attached and detached homes, but this number is only down 27% when compared to the sold homes of pre-COVID. So once again, these numbers that we're seeing new listing homes pending and obviously homes closed are all down. Part of that is, again, seasonality, but there's also a part of the fact that buyers are hesitant right now with the higher interest rates. Though I will say that over the last week, because interest rates had dropped, lenders have reported an increase in buyer activity. The median close price on all properties is down 9% from the peak in April of this year. Now, I like to watch this number because this number is very interesting. The media makes it sound like homes are losing their values. The market is crashing. But the reality is, these price adjustments might be from sellers getting a reality check. Because we all know when a seller goes on the market, they look to see what else sold in their neighborhood, what their neighbor did. And they may be looking back as far as April, and their neighbor down the street who sold back in April got, multiple offers and a lot more money over asking. Because back in April, the interest rates weren't hovering between 6 and 7 or over 7. So some of this is going to be a correction, because now sellers are in a different market compared to what was going on in April of this year, or even prior to April. The average close to original list price ratio was 94.9%. The median close to original list price ratio was 96.2%, and the average for 2018-2019 was 97.8. This is a 1.6 percentage point drop, showing us that home values are still holding strong. The median price of a home this year is up year over year by 4.2%, bringing the price to $560,000 from $532,000 this time last year. And that continues a trend we've been seeing over the last few months where, home prices continue to rise, but the rate at which they're rising, that's slowing down. The average price appreciation for 2018-2019 was 5.6%, and we are actually below this percentage now. Now, the median days in the market before you go under contract is now 21, with the average hovering around 34. And that's an increase from what we saw this time last year by a median of about 19 days. The average number of days in the market in 2018-2019 was about 32 and a half. So there was a small increase this year in the average days in the market. And a lot of that could again be due to seasonality, since rates did come down a little bit. Weeks of inventory is holding steady at 9, which I had mentioned before, and that was the same as last month, but still much higher than the 2 weeks of inventory we had last year at this time, making it feel like a more normal market. And lastly, let's talk about the Fed. As expected, the Fed raised the federal funds rate by another 50 basis points yesterday, to a target range between 4.25% and 4.5%, the highest level since December of 2007. And the primary focus for investors was the projected peak for the federal funds rate, which increased to 5.1%. Prior to this meeting, the investor outlook for this rate had been below 4.9%. And the CPI, the Consumer Price Index, which is a measure of the average change in prices over time in a fixed market basket of goods and services, is closely watched as an inflation indicator, looking at price changes for a broad range of goods and services. Now, core CPI, which is going to exclude food and energy components, which tend to vary greatly, have you got your energy bill lately, provides a clearer picture of the long-term inflation trend. Core CPI was up 6% from a year ago, below the consensus forecast and down from the 6.3% last month, but far above the Fed's targeted goal of 2%. Now, if all this has your head twirling around like it does mine, I think Elliot Eisenberg, the bow tie economist, sums it up well when he said, as expected, the Fed bumped rates 50 BPS earlier today to 4.375. Markets were hoping the Fed might halt increases going forward due to declining inflation, and because in September, Fed members anticipated raising the Fed funds rate slightly above where it is now. Those hopes were dashed. The Fed now expects to slowly raise the Fed funds rate another 75 to 100 BPS and keep the higher rate there through 2023. So bring on the recession. Well, that's exactly what the Fed has been pushing for. Remember, they want us to stop shopping, which I find ludicrous, especially at this time of year. Right now, with the holidays coming, when I've been out buying gifts for friends and going to local Christmas markets to support local businesses, I see a lot of people out, and I see the parking lots full. We'll have to see how long it takes to reach their goal of 2% core CPI. So what does this mean for you, the seller or the buyer in our market right now? Well, one, yes, homes are staying on the market longer. We're not seeing a large influx of new listings, suggesting that we're returning back to more seasonal norms that we haven't seen in the last couple of years. And then home prices continue to rise, even though they're rising at a slower rate due to the low supply of homes on the market. 3, seller concessions are becoming more prevalent, as builders and resale sellers are offering to help buyers buy down the higher interest rates. And then 4, the number of available homes for sale is similar to 2018-2019, so it feels really high, but that's only because the last 2 years the inventory was so very, very low. And 5, this is actually the best market for a buyer right now since 2019. And if you're a seller, homes priced right for the area are still getting multiple offers and selling quickly. Hi, my name's Peggy Dursthoff, and I'm a realtor at Live Denver Suburbs, powered by HomeSmart. And if you're thinking that it's a good time to buy or sell a house right now, let's connect. All of my information is down below. I'll share the latest market information with you and hear what your homeownership goals are. In the meantime, if you enjoyed this video, go ahead and check out this one over here, where I talk about some of the things you might want to know if you're thinking about moving to Colorado. Thank you so much for watching, and remember, friends, don't let friends rent.